Today, with the advances in technology, traders have developed highly complicated trading methods with sophisticated graphs. Let me tell you this, the best methods used by successful traders are quite simple. A simple method is easier to understand and easier to implement. Back in the early days of technical analysis, things were a bit more difficult. Traders had a hard time building trend indicators or oscillators, so the focus was on trading theories and concepts. Now, 99% of traders use candlestick charts mostly, including myself. At least one trend indicator, maybe an oscillator, which are even more complicated in their nature. Instead of keeping trading simple, we overcomplicate technical analysis by following too many signals generated by conflicting indicators or programs. But it wasn't like that back when technical analysis started. Bar and line charts, for instance, dominated the industry, as professionals and retail traders used them. Despite everyone using Japanese candlestick techniques applied on candlestick charts, the simplest kind of charts contain only a single line. Just one line is enough to filter the market noise, which is one of the reasons why most of the retail traders fail. A line chart is the simplest type of chart, representing the trading instrument's closing price on each day. This type of chart offers traders a clean, easy to understand view of the instrument's price. The interpretation of line charts is simple. They are basically price charts that connect the closing prices of a given market over a span of time. As the line charts only show closing prices, they offer a great value to traders by reducing noise. This chart is also good for visualization of the overall trend of a currency pair or a stock. Charles Dow, the developer of Dow theory, the groundwork for the technical analysis, was only interested in the close of the instrument. Dow believed that plotting a record of highs and lows tend to obscure the real value of the security or the stock, which is settled only by the close. For instance, here is the daily Euro-USD chart. It shows the price action on the pair by displaying one single line. This line connects the daily closing prices and results in a simple and easy to understand chart. So how to trade line charts? The simplest method is to trade line charts trendline breakouts. Trend lines are straight lines drawn on a graph connecting support points for an uptrend and resistance points for a downtrend. A trend line may rise, fall, or move sideways. Trend lines connect two or more support points that define the trend. As we all know, drawing trend lines is quite subjective, it's not a precise science. Draw them correctly and you'll have an edge over the market. How to draw the best trend lines? Or, more important, how to draw trend lines correctly? These are one of the most common questions among traders. Of course, we need at least 2 points in the market to draw a trend line. Once the second swing high or low has been identified, we can draw a trend line. Using candlestick charts, we have a situation. Should we use the low of the candle or the close of the candle? With line charts, drawing a trend line is an easy job. You don't need to worry about it. Look how easy you can spot and draw the trend line. No more confusion. Another simple approach is to look for trading patterns. Chart patterns are one of the most effective trading tools used by traders to identify continuation or reversal signals, to open positions and identify price targets. Line charts offer a good visualization of the patterns. If you pay attention at this example, we can clearly see several continuation patterns, a descending triangle and an ascending triangle, signaling a continuation in the underlying trend. And we can also see one reversal pattern, a head and shoulders, indicating a possible reversal of the underlying trend. Of course, a line chart should not be used by itself, as it doesn't provide enough price information, and for this reason, other complementing tools must be added. It's easy to read a line chart looking at past history, but in real time, reading price action and trying to predict the next price movements is not an easy job. Also, trading strategies are very hard to be backtested by using a simple line chart. Another viable line chart strategy is trading support and resistance. As mentioned earlier, line charts have one significant advantage and it is to filter the noise in the market. By displaying only the closing price and ignoring the price action between the opening and the closing prices, a line chart reflects the true market nature. Trends become more visible, turning points easier to spot, and the classic pattern recognition approach works best. Let's consider support and resistance for instance. Support and resistance are practically the foundation of technical analysis. The better traders understand that support and resistance levels serve as a starting point for developing an idea of what may happen next in what concerns the price movement. A support level is an area at which demand, or the buying power, is strong enough to stop the price of an instrument from decreasing any further. A resistance level is an area at which the supply or the selling power is strong enough to stop the price of an instrument from increasing any higher. A new support level often will be found above a previous trading range resistance level, and when a resistance level is broken, it becomes an area of support. A new resistance level often will be found below a previous trading range support level, and when a support level is broken, it becomes an area of resistance. With line charts, spotting support and resistance levels is very easy. Let's take a Dow Jones 1-minute chart as an example. This approach is pretty straightforward. You identify relevant support and resistance levels based on recent market swings and scalp these areas for a few pips. The horizontal lines joining market swings can be very subjective. In most cases, we can only approximate those areas. The technique of drawing support and resistance lines is simple. We just have to identify recent and relevant market highs and lows and connect the swings with a line. If the line includes 3 or more swing points, it means that the support or resistance level is more relevant. Look at this chart and see how powerful this simple technique is. Some support and resistance levels are respected to the pip. If the market breaks the support and resistance areas, look for an entry in the direction of the breakout. The conservative way is to wait for a retest of the support or resistance level and enter the market at the first sign of rejection of that level. You can pinpoint the entry with other technical indicators, depending on your preference, like the RSI, ADX or OBV. If scalping isn't your style, then line charts are also useful for swing trading. Let's take a look at the 1-hour Dow Jones chart. We have almost 5 months of price action, during which we recorded a strong rally to the upside, a huge market correction, and a period of consolidation. Just look how accurate some support and resistance levels are. Another way to trade with line charts is to use them together with moving averages. All traders, regardless of experience, know that moving averages provide resistance in bearish trends and support during rallies. Moreover, the rule of thumb says that the higher the moving average, the stronger the support or resistance the price meets. Furthermore, the bigger the time frame, the stronger support or resistance gets. One of the most relevant things to keep in mind when trading with moving averages is that they reveal a trend's strength. The more the price comes to the moving average, the weaker the trend becomes and eventually breaks it. So instead of using candlestick charts, try using line charts and consider a relevant test only when the line chart touches the moving average. Out of the 3 types of charts offered by most trading platforms, bars, lines and candlesticks, the line charts are the least likely to be used by retail traders, let's face it. But that's only because traders are scared of missing important information by looking only at the closing price of a period. What you need to consider is the fact that the closing price will give you important information about the price action during a trend. By avoiding the upper and lower shadows of regular candlesticks, using line charts will get you closer to the real price action. I'm not saying you should ditch the candlestick charts and trade only the line charts. But next time you are in doubt and you don't know if a trade setup is valid or not, open a second window and take a closer look at the same image, but on a line chart. It will save you a lot of losses in the long run. If you got any value from this and learned something new, Don't forget to subscribe, click the bell icon to stay in touch in the future, and leave us a like to show your support. Until next time.